You've probably heard nothing about July 9, but this one date could change everything about your investment portfolio without warning. Stay tuned. This might be the most important move you make all year. Back in April, President Trump announced a 90-day pause on new tariffs to ease pressure and avoid market panic. But that pause ends this Tuesday, July 9th. And this time, it could trigger massive new tariffs on cars, steel, and semiconductors, with threats as high as 60 to 70% import duties. This isn't theory. The last time tariffs hit this hard, entire sectors got dragged down, and ETF investors paid the price. In April, when the Liberation Day tariffs were announced, a 10% base rate on nearly all imported goods and up to 34% for China, Vietnam, and several EU countries, the market wasted no time. Every time there's uncertainty, these are some of the sectors that get hit hard first. The Technology Select Sector Spider Fund, XLK, dropped over 12% within days, dragging its year-to-date performance down to minus 21%. These companies are deeply tied to overseas manufacturing, and even though semiconductors were technically exempt from direct tariffs, the products they power, like phones, EVs, and cloud servers, were not. That's why semiconductor ETFs like SMH and SOXX stayed deep in the red, both down around 25% for the year. And it didn't stop there. Consumer stocks got hit next. The XLY ETF, home to companies like Amazon and Nike, dropped 11% following the announcement, with a nearly 20% loss year to date. These businesses rely on cheap global supply chains. Add tariffs, and suddenly every product costs more to make, sell, and ship. Retailers were also hammered. The XRT ETF, which tracks budget-focused chains, fell 8% in just one day. For these companies, shrinking margins and weaker consumer demand is a double blow. Here's what's wild. Even sectors that weren't directly targeted felt the ripple effect. The energy sector, for example, saw the XOP ETF, which holds U.S. oil and gas explorers, fall more than 10% that week. When tariffs slow global trade, there's less manufacturing, less transport, and ultimately less oil consumption. Financials were next. XLF, the banking ETF, sold off sharply. When uncertainty rises, corporate lending, investment deals, and growth plans all pause, and banks lose momentum fast. International markets didn't escape either. The iShares China Large Cap ETF, FXI, lost 16%. And the VanEck Vietnam ETF dropped 12% just days after the announcement. These economies depend heavily on exports, and tariffs at the U.S. border hit them right where it hurts. All of this unfolded in just a few days. That's why July 9 matters. The 90-day tariff pause is ending, and this time, the new rates could be even higher than what we saw in April. If that happens, don't be surprised if the same pattern repeats or gets worse. April's tariff shock was just a preview. If tariffs escalate further this week, we could see another sharp sell-off, possibly faster and deeper. The last trade war showed us how brutally markets can move when tension rises. But here's the good news. Not every sector collapsed. A few ETFs held their ground, and they could do it again. Utilities and healthcare stayed surprisingly stable. The XLU ETF, which tracks utility companies, barely moved during April's sell-off. These companies operate locally, not globally. They don't depend on imported parts or fragile supply chains, and they pay steady dividends, which investors love in times of stress. XLV, the healthcare ETF, also remained flat. Healthcare demand stays consistent even when markets panic. Most of the revenue in this sector is domestic. That makes it a safe space when global shocks hit. Another unexpected winner was the US dollar. The UUP ETF, which tracks the dollar's strength, rose in April as global investors rushed to safety. If tariffs spike again, this flight to quality could repeat, and UUP might move up again. Defense ETFs like ITA were also less affected. While industrials got crushed, military contracts and government spending stayed strong. If tariffs trigger broader geopolitical tension, this fund could even benefit. And let's not forget gold. While gold prices held steady in April, a bigger market drop could send investors running to safe haven assets. That's where GLD, the Spider Gold Shares ETF, comes in. If panic sets in, gold typically shines. Bottom line, if you're worried about more tariffs, shift your attention. Focus on ETFs that aren't exposed to global trade, ones that rely on local demand and offer more stability. They might not explode in growth, but they could protect your portfolio when everything else is falling. Understanding these tariff impacts is crucial, but this is just one piece of the puzzle, so make sure you're subscribed for our weekly ETF breakdowns. We'll be tracking what actually happens on July 9th and what it means for your portfolio. And next, You absolutely cannot miss the invisible killer. Why your cheap ETF could be stealing your retirement. It's already happening, and most investors don't even know it.